If you're looking at a whole life insurance policy for cash value, does it matter if you pick non-direct or direct recognition? Some will say, yes, you have to go with non-direct recognition because you're penalized with direct recognition anytime you take a loan. Whereas others will say it really doesn't matter. Today, we're going to look at a case study that compares the two side by side. But let's start with how non-direct and direct recognition works. So I'll start with non-direct recognition because this is the easiest one for most people to understand. What non-direct recognition means is that the insurance company does not recognize the fact that you take out a loan with respect to how they apply dividends to your whole life insurance policy. What it means is that you are going to receive the same dividend interest rate on any money that you borrow against your policy and what you have not borrowed against your policy. So for example, let's pretend that you have a MassMutual whole life insurance policy, and for 2026, their dividend interest rate is 6.60%. We'll pretend that you have $100,000 in cash value, and if you just let the money sit and grow and never borrow against it, you're going to get that dividend rate of 6.60%. But we're not going to do that. We're going to borrow against it. So let's assume you borrow half, $50,000. When you take a loan, you will pay loan interest to the insurance company, and you will also see that your death benefit will be reduced by the amount that you borrow. Now, how do the dividends work? Well, the $50,000 that you did not borrow will receive the 6.6% dividend interest rate, and the $50,000 that you did borrow will also receive the 6.6% dividend interest rate. Because the product is non-direct recognition, they do not recognize the fact that a loan is outstanding, and they will pay you the same dividend interest rate on any non-borrowed and borrowed cash value. Let's go over direct recognition. So with direct recognition, it's similar, but a little different. So the insurance company does recognize the fact that you take out loans with respect to how they apply dividends to your policy. So what happens is when you take a loan against your policy, you still receive dividends on everything. However, you will receive a different dividend rate on loaned cash value compared to non-loaned cash value. First, I want to address a big misconception that I have seen for years, which is with direct recognition, the claim is often made that when you borrow against your life insurance policy, your dividends are either reduced or you don't get dividends at all on the cash value that you borrow. That is not true. The truth is that it depends. It really depends on the specific insurance company that you pick and how they practice direct recognition. Because what you will find is that the dividend rates could be higher or lower than the standard dividend rates on cash value that you borrow. So to give you a couple of examples of this, the timing is also important, meaning when you started your policy. If you were to go back to older Guardian policies that were written before 2016, they had a fixed loan interest rate of 8%. The dividend rate was 6% and change back then. So what this means is when people would borrow, they felt like they were being punished for taking a loan against their policy. So what Guardian did is anytime one would take a loan against their policy, if they were paying an 8% loan interest rate, Guardian would apply an 8% dividend interest rate to the cash value that they borrowed. They still do the exact same thing with those policies. I know this because I have one of those policies, and every time I test it out, I see that to be the case. Now, for Guardian policies that were issued after 2016, specifically from 2016 through 2021, those were issued with a 6% fixed loan interest rate. Guess what they did? Anytime one would borrow against the cash value, the dividend rate applied to the borrowed cash value would be 6%. And then the dividend rate applied to the non-borrowed cash value would be whatever the dividend rate was for that year. And then for policies issued since 2021, They do things a bit differently because they have a fixed loan interest rate now of 5%. They actually reduce the dividend rate to 4.5% on borrowed cash value, and the non-borrowed cash value receives whatever the dividend rate is for that year. So that's one insurance company. If you look at Northwestern or other companies that practice direct recognition, you will see that they all do things a little bit differently. So that is beneficial to be aware of. However, that's all meant to illustrate the fact that it does depend. So let's look at an example of direct recognition. Let's pretend you have a MassMutual whole life insurance policy that's direct recognition. The dividend rate is 6.60%. You have $100,000 in cash value, and you decide to borrow $50,000. Just like non-direct recognition, you're going to pay interest to the insurance company on that loan, and your death benefits will be reduced by the amount that you borrowed. Now, how do the dividends work? This is the question with direct recognition. So the $50,000 that you did not borrow, that receives the 6.60% dividend. The $50,000 that you did borrow, that will receive a different dividend interest rate. And you will want to ask your agent what that dividend rate will be, or to see an illustration with loans taken and repaid. This way, you can see exactly how that direct recognition treatment works with the policy that you're looking at. That's exactly what I would do. The thing is, depending on the company and the year that you started the policy, that dividend rate could be higher or lower than what the current dividend rate is, 6.6% in this example. So we'll go through an example in a moment, but first, I just want to touch on a handful of companies and what they practice. So starting with the four major mutual companies, if you look at MassMutual, they offer both non-direct and direct recognition. The thing is, you have to choose when you start the policy. And whatever option you choose, you're locked into for life. If you look at Guardian will always start out as direct recognition. However, they do give you the option to switch to non-direct recognition in policy year 10. It's a one-time opportunity you have to do this. If you do that, though, the loan interest rate changes from fixed to variable. Not everybody likes that because Guardian's got a unique provision where at the later of typically 20 years or age 65, they reduced that fixed loan interest rate. Remember where we mentioned 5% earlier? Down to 3.5%. And with some products, it's a fixed rate of 3%. All these nuances you got to be aware of. New York Life, they are non-direct recognition. Their non-direct recognition functions almost identical to MassMutual's. If you look at Northwestern Mutual, they practice direct recognition. If you look at Penn Mutual, they practice direct recognition. What's interesting about them, they are one of the few companies out there that practice direct recognition that also have a variable loan interest rate. Most companies that practice direct recognition operate with a fixed rate. And then you've got Lafayette Life, who practices non-direct recognition. So for the sake of looking at a true apples-to-apples comparison, MassMutual, they offer both non-direct and direct recognition. What this means is we can illustrate the same product with the exact same design and then illustrate loans being taken and repaid and see the impact both of non-direct and direct recognition. It lets us see a true comparison without looking at different companies and products, which is never a real apples-to-apples comparison. So again, with MassMutual's non-direct and direct recognition options, we do need to pick which one we want up front. Now, you will find that how we pick is tied to the loan interest rate, meaning on the application, you won't be able to pick, I want non-direct or direct recognition. However, you will be able to pick if you want a variable loan rate or a fixed loan interest rate. And what you'll find is that if you pick a variable rate, your policy will be non-direct recognition. And if you pick a fixed rate, then your policy will be direct recognition. And the variable rate is variable. This is what people always ask. Well, how variable is it? It's variable. It does fluctuate with interest rates in the economy. At the time of this video, it's December. The December loan interest rate is 5.10%. In January, it'll be 5.33%. And in February, it'll be 5.50%. Whereas the fixed loan interest rate is pretty straightforward. It's 6%. And if you pick that option, it's 6% forever. Like contractually, you're locked in, which is nice. So let's compare the two side by side. We've got illustrations for all of the options. So first, we have an illustration with no loans. This is really the foundation that we're setting to look at both non-direct and direct recognition. Meaning, if you look at this example, we're funding $100K per year for 5 years. There's your cash value at the end of 5 years, and there's your death benefit at the end of 5 years. If we look at the loan illustrations, you'll notice that everything for the first 5 years will be identical. So here's our loan illustration with non-direct recognition. There's your funding, there's your cash value, there's your death benefit. If we do the same thing with direct recognition, it's identical again. Same company, product, everything. The difference is that loan recognition treatment. So how you can tell which one's which is if you ever receive an illustration, you go up to page 2, it won't say non-direct or direct recognition here, but it will give you the loan interest rate. And it will also give you this term. Is it adjustable or is it fixed? This one's adjustable, which means it is non-direct recognition. If we look at the direct recognition illustration and go up to page 2, what do we see? There we go. Loan interest rate, 6%, but fixed, which tells us it is direct recognition. All right, cool. So everything's identical with these two, except for the loan rate option. One's variable, one's fixed. Let's look at a side-by-side comparison. If you want to see the numbers on the actual illustrations, you can rewind this video as we had the illustrations there. For the sake of making everything simple, we're going to look at the rest on Excel. So here we go. Here's the growth illustration. So this is what it looks like if I pay money in, just let it sit and grow. Cash value break-even point between 3 to 4 years. That red box represents the term rider being removed, which is why the death benefit drops, but that does boost the cash value growth. So the first thing I just want to touch on very, very briefly here is this. Here is the dividend column from the life insurance illustration. If you rewind the video, you'll see this column on the formal illustration. So that dividend column, when you see that, what does it make you think? Most people think that that's what their money is growing by, but it's not. Look at your first year cash value. What is it? It is just about $90,000. How much did you pay into the policy? $100,000. Did you make money or did you lose money? You lost money, about 10 grand. So what I like to add is a column that says yearly cash value growth, because the dividend column is so confusing. We're going to focus on the dividend column when we look at non-direct and direct recognition, but boy, does it confuse people. The yearly cash value growth column just shows your bottom line growth year over year. To simplify, if we look at year 1, you're at 89,869. Year 2, you pay 100, and at the end of year 2, your cash value is 187,584. If you put it under a mattress, it'd be worth 189,869. That means you lost money. First and second year, we had a loss instead of a gain. Then from that point forward, we see that it grows. And for the next 3 years, the net growth is less than the dividend. That's where people get confused. The dividend column makes them think that their money is growing by more than what it's actually growing by. And then after that, it begins to even out. I always like to add this because it's confusing and it helps me when I look at my bottom line every year. And if you're a percentage guy or girl, you might like this as well. We've got the dividend rate, which is a gross rate, and then the annual yield, which displays your net growth rate year over year, and then also your internal rate of return. And if you are looking at a non-direct recognition illustration, this will be consistent. If it's direct recognition, this will not be consistent, because if the dividend changes, that net yield is going to change as well. All right, let's look at the loan illustration. So we'll start with non-direct recognition. Here is our growth illustration to the left and our loan illustration to the right. When you take a loan, the question I would ask, what is the impact that that loan has on my policy? And I would start by looking at your policy without any loans. So here we take a loan in year 6. Why I waited that long is because it's after we funded the policy, and it just makes it simple to say money in, money out, then I start paying the loan back. So I took that $500,000 loan. There's my cash value. Think of that as your equity, how much money you can access. We took just about a maximum loan. And then look at your death benefit. That will also reduce when you take a loan against your policy. Then we started to pay it back. In this example, at $100K per year, you can pay it back however and whenever you want. I did it at $100K because it's a round number, and it also pays it back fast to make this example easy to follow. So we can see how much goes toward interest and also principal. And when it is paid back, here in year 12, there's your cash value at $764, and there's your death benefit at about $1.25 million. Now scroll your eyes to the left and tell me what you notice here at the exact same point in time. Yeah, everything is identical. And that is because this is a non-direct recognition illustration. You get the same dividend on any money that's borrowed and non-borrowed. And this might help illustrate that. So when you look at those dividend columns, during the years that a loan balance is outstanding, do you see any changes? No. The growth illustration and the loan illustration are exactly the same. Now, let's look at the direct recognition illustration. Here we go. No loans, exact same policy. Loans, here we go. So you can see the exact same thing occur when you take that $500K loan, reduction in the cash value, also the death benefit. But when we pay it back, here we go. How long did the non-direct recognition policy take to repay? 12 years. What about this one? A little bit longer. Why? Because your loan interest rate is higher. It's 6% instead of 5.1% with the non-direct recognition option. So more loan interest with the same out-of-pocket payment every year means it is going to take longer to pay that loan back in full. However, while I've paid more interest, what does it look like once it's repaid? Your cash value is about $822. Compared to the example where you just let it sit and grow, $808. Death benefit is a little bit higher too in the example where you borrowed and repaid. What does that mean? With direct recognition, in this particular case, you have more money when you loaned and repaid. Interesting, isn't it? Here's why. Check that out. What do you notice about the dividends in this example, particularly to the option on the right, when that loan balance is outstanding? They're higher than the example to the left. You got more money, which is good. So here's an example where we see a higher dividend interest rate applied to our policy when we have loans outstanding. Here's the question I would ask if I'm you. How much more am I paying in loan interest with the direct recognition option? And I want to see that lined up side by side with how much extra I got in dividends. This way I can see, call it the true spread or a real apples to apples comparison. We did that too. Here you go. So here are the two options side by side. I just started in year 6 here so we could capture everything on Excel. And here's what I really want to highlight to start. The interest payment. With the non-direct recognition option, your loan rate's 5.1%, whereas with the direct recognition option, your loan rate's 6%. So you're paying more in loan interest. Okay? How much more? There you go. There's the total dollar amount you paid in interest for both of these examples. So how much more did you pay when the loan's paid back? You could calculate it, or you could just look at this. So when the loan is paid, going with direct recognition, because you had a 6% loan interest rate, you paid an additional $20,451 in interest. But if we look at the cash value difference, this is how much more money you received as a result of going with the direct recognition. You got an extra $13,689. So your net spread in this example is minimal, $6,700 negative when the loan's paid back. But because you have more cash value, that cash value will compound over time. What happened? Well, the spread works out in your favor because you see more and more in cash value with a direct recognition option compared to the non-direct recognition option. Here's what I would say about this. Depending on the variable loan rate at the time we run this illustration, the numbers are going to either favor non-direct or direct recognition. For example, I'm running these illustrations in December of 2025. If we run these illustrations in February of 2026, 2 months from now, the variable loan rate will be 5.5% instead of 5.1%, which will skew everything more in favor of direct recognition in this example, because I would have paid more in loan interest while still getting that higher dividend with a direct recognition option on the borrowed cash value. So it doesn't always matter. It's really my point here. And I'm going to touch on that in my conclusion. The last thing I just wanted to show quickly is check this out. What if I don't pay anything at all? This question always comes up. This is a non-direct recognition example. There's the loan coming out. And there is your cash value growth over time. Why this works is not because of the dividend, because the loan interest is higher than the dividend. Here's why. Whenever you're looking at taking a loan and not paying anything back, really what you want to look at is the net cash value growth. Blue equals this minus this equals this minus this minus this. So what I would do is compare the two side by side. There's your loan interest. There's your cash value growth. And that is why, without paying any loan interest, we're still going up. If that loan interest is higher than the growth, what do you think happens? Not as attractive. That's where I definitely advise paying some of the loan interest. Okay, let's wrap this puppy up. Hope you're enjoying this. I have a lot of fun with this topic. So the conclusion is as follows. Firstly, if you're looking at a non-direct recognition policy, in most cases, you'll see a variable loan interest rate. Whereas with direct recognition, you'll typically see a fixed loan interest rate. That is most common. It is not true in 100% of cases, but it is most common. Now, in a low loan interest rate environment, non-direct recognition typically looks a lot better on paper. So you can look at an example of that. If you were to look at the year 2022, the early part of it, MassMutual's 10-pay product with a variable loan rate had a floor of 3%. MassMutual's dividend rate in 2022 was 6%. You could choose a fixed loan interest rate, but people would look at that and say, why would I do that? Because the clear advantage is to go with non-direct recognition because I get that 6% dividend rate and I only pay 3% in loan interest instead of paying 6% with the fixed rate. So in a low loan interest rate, it's much, much easier to make a case that non-direct recognition is better on paper. I'm not saying that one's better than the other. Whereas in a high interest rate environment, direct recognition typically looks better and is more appealing to people. The reason why is because in a high interest rate environment, my dividend might be higher, say that's 8%, but my variable loan rate will also be higher. The two move up and down together. So the variable loan rate could be 8%, it could even be 9%, whereas the fixed loan interest rate is still 6%. So the advantage in that case would go to direct recognition because I'm only paying 6% in interest instead of 9% in interest. And if you ever want to see what the loan rate history has looked like, you can request it. So here's the dividend rate history with MassMutual going back to 1978. And then here is some loan rate history, not going back to 1978, but 1983. What did interest rates look like in the 80s? Yeah, they were high. Look at that. This shows what it was each month. Interesting stuff, right? And you can look at everything decade over decade to see exactly what the variable loan rates looked like. And we could even cross-reference that with a dividend interest rate each year. But we can see all the history. Here's some more recent history. That's where I pulled the December loan rate. It's also in the illustration software. But then we can also see January and February and what those loan rates will be. And I'm highlighting the 10-pay product because that's what I illustrated. Anyway, they do move up and down with each other over time. So here's what I would say. Non-direct versus direct recognition. One is always going to look better than the other on paper, depending on the interest rate environment. But what I have seen when I've examined the net results with actual policies or looked at case studies similar to the one we just looked at is that the net results come out almost identical, or they are so close to each other. And if I'm looking at a direct recognition policy where the dividend rate is reduced on borrowed cash value, well, that's usually a case where the policyholder is paying less in loan interest. So some companies do reduce the dividend that's applied to borrowed cash value. However, where I win as a policyholder, or where I make that up, is that I'm also paying less in loan interest. So my out-of-pocket is less in terms of what I'm paying to the insurance company every year. And when you factor that into the equation, things do tend to work out in the wash from what I've seen. So here's what I would say. If you're looking into life insurance and this topic comes up, non-direct and direct recognition, if you're told that non-direct recognition is better, it's probably because the agent you're speaking with prefers non-direct recognition. That is what I have seen for years, or he or she works for a company that practices non-direct recognition and trains their sales force on a million reasons why non-direct recognition is better than direct recognition. That's what I've always seen. I've also seen that when I have worked with other companies and they try to provide that training to me. Like, I get it. It's good information. But when I do a true non-biased comparison, I don't see much of a difference. Now, at the same time, if you're speaking with an agent and you're told that non-direct and direct recognition work out to be the same, it's usually because the agent A uses both, or B, they've learned that they end up being the same. That's what I've seen time and time again. Insurance companies know what they're doing. Non-direct recognition is just easier to understand. So what I would do whenever you're looking at a whole life insurance policy for cash value is look at loan illustrations so you can understand how it works. Understanding how it works is almost as important as how it actually works when you look at the numbers. But I would understand how it works and then really look at everything that comes with the policy and pick the company and product that you're most comfortable with. I hope you enjoyed this video. If you'd like to see a case study that examines non-direct and direct recognition with Guardian, I included a video here. As always, I hope this helps.